You look at this chart and you see a crime scene. You see the tariff lows at $74,600. The critical price floor established during April's trade war uncertainty shattered in a single session. For the last 48 hours, retail traders were betting on a textbook support. They believed the political narrative was their safety net. They were wrong. And now, staring at the red candles, you see panic. But let me be clear. The chart isn't lying. Your interpretation is wrong. This drop isn't a system failure. It is a filtering mechanism. The market didn't break the 74,000 level to destroy value. It broke structure to find the one thing the global financial system is starving for right now: liquidity. This is not a random sell-off. This is a calculated, structural transfer. To understand the transfer, look at the anomaly. Why did the collapse accelerate exactly at the tariff lows? Because that is where the leverage was hiding. The algorithms pushed price into the stress window. Now, look at the institutional outflow. ETF data confirms a $272 million bleed. Wall Street is de-risking. By every historical model, a breach of the tariff lows combined with this level of outflow should have triggered a 20% collapse. It didn't. The bleeding stopped. The price stabilized immediately after the sweep. That is not market strength. That is absorption. Who has that kind of firepower? And more importantly, why are they only showing their hand when blood is on the street? In financial forensics, timing is the only evidence that matters. At the exact moment of peak liquidation near 74,000, Binance disclosed the second batch of their SAFU fund conversion, their strategic reserve designed to protect users during market stress. $100 million moved from stablecoins into Bitcoin. This isn't speculation. The transaction is verified on-chain. But more importantly, this is a disclosed, time-based process. Binance has committed to a 30-day conversion window. This tells us something critical about how large balance sheets operate. Backstops don't operate on price targets. They operate on stress windows. They do not chase price. They only become visible when the market structure fractures. Now, let's do the math. The retail market is panicking over a $272 million outflow from ETFs. But quietly, sitting on the sideline, is approximately $800 million in remaining buying power from just one emergency fund, based on disclosed allocations. That is nearly 3 times the size of the selling pressure that caused this crash. And realize this, that capital isn't fleeing. Its presence becomes visible only under stress. While traders are staring at the exit door, institutional architects have already locked the entrance. This imbalance is invisible to the naked eye, but it is glaringly obvious on the ledger. This brings us to the verdict. The tariff low narrative is dead, but a liquidity narrative has just been revealed. A stress boundary has been identified. However, the anomaly doesn't stop here. If you zoom out, you will see something disturbing. Silver crashed at the exact same moment as Bitcoin. Why would a critical industrial metal, essential for NVIDIA's AI chips, sell off during a tech boom? Is it another liquidity hunt, or is it an industrial raid? There is a second layer to this crime scene that nobody is talking about. This file offers no price predictions. The crowd loses money because they react to price. Institutions win because they exploit structure. A structure has been revealed. This is market signals. Hit subscribe because the silver file drops next, and it reveals who is draining the vaults, while everyone else is watching the charts.